Protect your retirement from sequence of return risk. You know, no one can consistently predict how stocks and bonds and other investments will perform, but you may be able to protect your retirement against the risk from a falling market. This is called sequence of return. So in this educational video episode, I'm going to address how does the sequence of returns cause some retirees to outlive their money. Get ready. This is going to blow you away. So my name's Doug Andrew, and I've been a retirement planning specialist now for nearly 5 decades, helping thousands of clients prepare for a comfortable retirement by optimizing their assets and minimizing taxes. And I help people eliminate 3 big dangers during their retirement that cause most retirees to outlive their money. The number 1 danger is taxes, okay? The second is inflation, and we're experiencing taxes going up because of irresponsible government spending. But also the printing of money is causing inflation, which is sort of like a hidden tax. And it causes the cost of living right now at the current real rate of inflation as of the recording of this episode. It's going to double in 4.8 years. And so you're going to need twice as much money in 5 years to buy the same gallons of gas and loaves of bread that you can buy today. And that's going to hurt a lot of retirees. Well, the third big danger is market volatility. And so in this episode, I'm going to talk about how you need to really seriously consider your money being exposed to that market volatility, because Wall Street was not designed to create predictable income during retirement. In fact, that's why most broker-dealers tell their advisors never to illustrate more than a 4% payout, because the average retiree is really only earning about 3.5% with their IRAs or 401ks invested in the market, because they get emotionally involved and they wait when the market starts to take a nosedive, and then they finally sell enough already low. And then they wait till the market's rebounded, and then they buy high. And so if they bought and held, they'd probably average 9.14%, according to Dalbar, who studies investor behavior, and they would net about 6% after tax. Instead, they're only earning about 3.5%. So that's why the financial services industry only wants you to pull out 4% a year, which will slowly deplete your nest egg, but not before your LE, which means life expectancy. In this episode, I am going to borrow from an illustration prepared by Pacific Life, because they understand this. And one of my favorite strategies is indexing. I'm not talking about index mutual funds. Indexing is where you participate when the market goes up, but you do not lose when the market goes down, because your money is not invested in the market. It's linked to the market, okay? And so I want to illustrate this by showing an example that they came out with on this brochure. So they're using an example of a retiree, let's say that is age 65, and they have $1 million nest egg. And so they think that they can average 6%. And in actuality, the average rate of return during the 14 years from the year 2000 to 2014 was 6.07% in the S&P 500, okay? So that's the average return. But they're saying if you started at age 65 and took out 5% a year, 50,000 out of $1 million nest egg, and you increased your distribution by 2.5% every year to sort of hedge against inflation. If you started in the year 2000, and what happened after 2000 and 2001 to 2003? Well, that was the terrorist attacks of 9/11, and the market dropped about 40% in that period from 2001 to 2003. And it took 4 years to come back to break even in 2007. Then what happened in 2008? It dropped 40% again for the second time in a decade. And it took until 2012 to come back. And we're talking about just 2 more years after that. Well, if you started out with $1 million nest egg during that roller coaster ride, your actual account value, because you're taking money out during this downturn, okay, is shown here in the green. your $1 million nest egg, the net value, even though you're averaging 6.07%, would be down to $98,000, just about depleted at the end of that 14-year period, because the sequence of returns started out during a downturn, 2001 to 2003, and then 2008. That spells disaster for people who have their money in the market. So what if you just reversed that? Let's say that at age 65, that was the market performance in the year 2014, and then 2013, and then 2012. Let's just reverse it. Just by reversing it, the average is still 6.07%, but it's shown here in the blue. If you retired and you just fortunately retired when the market was going up, okay, then your account value would have gone up and come down, and at the end, it would have been worth $944,000, just about the full million. Even though the average was 6.07%, there's a huge difference. And so what is the difference? That's $846,000 of difference because of the sequence of the returns. So the message is here. When you retire, are you going to worry about timing when you retire or when you start taking income? Or are you going to have to start and stop taking income out of your IRAs and 401ks in the market because of market downturns? Are you going to have to just hope that the market is going up when you first retire so that you can weather when it goes down? Because if the market starts going down at retirement, you better watch out because you could definitely outlive your money. So sequence of returns matters big time. A lot of people don't understand this. The message here is the average return in both scenarios was 6.07%. But one ran out of money almost. The other one still maintained almost the $1 million value after 14 years. So how do you solve this? What should you be doing? This is why I have helped thousands of people with at-retirement planning, which is totally different than for retirement planning. This is why I've advised many people, ideally, at least 5 years before they retire. But if you're already retired, it's not too late. The sooner you do this, the better, is to perform a strategic rollout. That's not a rollover. A rollover's taking money in your 401ks and rolling it over to IRAs. And even if you think by putting it into bonds or whatever is helping, no, you're postponing and delaying the tax. You're actually compounding the tax by stringing it out. So I came up with a strategy called a strategic rollout. This is where usually over a 5-year period, you're rolling the money out of your IRAs and 401ks, even in a down market while the account values are lower, to get the taxes over and done with sooner than later in today's lower tax rates, because most Americans believe that taxes in the future will likely be higher. Why? Because of irresponsible government spending and the printing of money. So we have helped many, many people roll money out of their IRAs and 401ks. They get the money out, the tax is over and done with. In the tax thresholds that will be the lowest they will likely ever be in. And they're so grateful that they've done that, and they've saved $250,000, $500,000, $750,000. We saved one couple, both husband and wife were physicians. We saved them $1.2 million of unnecessary tax. We took one California couple from the highest tax bracket to a 0% tax bracket in 5 years. They had $6 million when they came to us in their IRAs and 401ks. They bit the bullet and paid $2 million in tax over the next 5 years, and they netted $4 million. And that $4 million has grown now to double $8 million in 7.5 years tax-free. That $8 million now can generate usually $600,000 to $800,000 a year of income without depleting principal. They don't need that. They only need $300,000 to live on because it doesn't even show up on the front page of their 1040 tax return. The IRS knows they're receiving that, but it's not taxable. But see, they don't have to worry about the market and when should we access money, because with indexing, when the market goes up, they get to benefit. They have locked in gains of as high as 16 and 25%, even 61% when the market went up. But when the market went down, they didn't make much of anything that year, but they didn't lose. And so that's why they were able to average between 8 to 10% payouts without depleting their nest egg. That's called indexing. Your money is not invested in the market. It's safely tucked in an insurance company. That $1 million nest egg is earning a conservative rate of return based upon the insurance company's portfolio of AAA and AA bonds or mortgages on shopping malls and skyscrapers. And you can settle for the general account portfolio rate of, let's say, 4%. That's $40,000 tax-free on $1 million if you want. But anytime you feel bullish about America, you just say, keep my $1 million safe, but you can take the interest on my $1 million, the 4%, that $40,000, and fund an options budget to buy upside options in the S&P or the Dow Jones or the market. So they buy options. If the market goes up 8%, they pay you $80,000 on your $1 million. If it goes up 12%, they pay you $120,000. They may cap you. Like the cap could be 16%. They cap you at a 16% return because they can only do so much with the interest on your $1 million. Your $1 million cannot be invested in the market. If the market crashes, the options just expire at the end of that year worthless. But you don't lose your $1 million because your $1 million's not in the market. Only the interest on your $1 million was buying the upside options. This is called indexing. If you want to learn more about how indexing can solve this whole problem with sequence of returns so that you don't have to worry about your money in a volatile market, eliminate the danger of taxes, inflation, and market volatility, all three of those dangers, by using a maximum funded indexed insurance contract where I have been able to average 8 to 10% payouts on a $1 million nest egg, let's say, without depleting principal. How do you learn more about this? Well, I've been blessed in my career to have authored 12 books thus far, but my 11th book has been flying off of our warehouse shelves. It's called The Laser Fund. We send out about 250 of these a week. Now, you can claim your free copy of this book. It retails on Amazon for $20. I will gift you a copy of this for free. How do you claim your free copy? Simply go to laserfund, L-A-S-E-R, fund.com or click on the link below. You contribute a nominal amount towards the shipping and handling, and I'll cover the rest of that cost. I'll pay for the book. I'll fire out a hard copy to you via priority mail. And you can also check out the options to listen and learn, watch and learn, but check out some of the educational webinars that we teach on a regular basis. They're free. You can even schedule an appointment to talk to an IUL specialist with no cost or obligation when you're in there. But see, this is not about me. This is about your brighter future. This book is actually two books. This side is for the left brain learner with all the charts and graphs. This side has 62 actual client stories. And one of those chapters talks about this concept of strategic rollouts. So don't put your retirement at risk in the market with your advisor telling you, oh, this is averaging 6%. Because sometimes averaging 6% can cause you to deplete your nest egg depending upon the sequence of those returns. So learn how to protect yourself and your hard-earned money in your savings by checking out a laser fund.